Howdy, folks. Welcome to Liberty Call. Today is Friday, December 1st, 2023. Christmas is almost here. Woo! I get to go see my kids and my granddaughter. Very excited in a few weeks. But anyways, hope everyone's having a good Friday out there. Well, it's not really Good Friday, but it's a good Friday. It is a bit overcast here in central Colorado along the Front Range. A lot of clouds, and we're due to get some more snow. Wah, wah, wah. So not too much. Now, at the higher elevations up at the passes, I think they're going to get somewhere between 1 and 3 feet. We might get a few inches out here. So anyways. All right. Well, if it is your first time watching Liberty Call, yes, you, I'm talking to you wearing the purple shirt. If you could give me some thumbs up, a like, a share, subscribe, a follow, and press that notification bell because you don't want to miss anything because we're going to happen in the markets, some articles, some economic data. Got a bunch of good stuff for you. All right, let's go ahead and get to the numbers for today. Dow Jones was up 0.82%, 294 points, closed at 36,245. The S&P 500 was up 0.56%. I'm sorry, Dow Jones was up 0.82. S&P 500 was up 0.56, closed at 45.93. NASDAQ was up 0.55%, closed at 14,305. The VIX was down 1.86% today. It's at 1268. Canada up 1.07, Brazil up 0.55, and Mexico down 0.31. A little weird there. Germany was up 1.12%. The UK was up 1.01. France was up 0.48%. The Netherlands was up 0.83. Spain up 0.82%. Italy up 0.64. Switzerland up 0.3. And Portugal up 0.81. Russian exchanges, both red. MOEX down 0.74. RTSI down 1.77. And the Asian markets, the Nikkei in Japan was down 0.11%. Australia down 0.2%. New Zealand was up 0.03%. In China, the Shanghai was up 0.06%. The Shenzhen component down 0.07%. China A50 down 0.91%. DJ Shanghai up 0.04%. Hang Seng down 1.07%. And the Taiwan weighted was up 0.03%. All right. So, like I said, it's a start to a new month, and most of the markets are in happy moods. Not sure why. We still have a lot of negative data out there, but hey, people want to keep putting their money at risk. Excuse me. That's their problem. All right, let's go ahead and bring up the see how the markets did for the week. Let's go to the weekly chart, turn off all the stuff there. All right. Starting out with the Dow Jones. Where's the line? It's hard to see. It's about right there. Looks like it's going to finish the week up about 2.53%. The S&P 500 up about 1%. The NASDAQ looks like it was, start at the bottom of the candlestick. Looks like it was up 0.55%. Dow Utilities up 1.79, and the Dow Transports up, 3.88. That's the big one it's kind of a minor index, but it looks like of the three majors, the Dow was the big gainer up at 2.53. So, all right, let's zoom out and take a look and see how things are trending right now. We have been in a bit of a uptrend since, I guess, the end of October. All of November was just a solid month. Starting out here, we'll start out with October 30th, and 11.39% for the Dow, the S&P 500, 11%, and the NASDAQ. 30th. There we are. And the NASDAQ, 11.85. Wow, all these double digit for the month. So, but let's back out a little further and look at the last basically 2 years. We can see that January of 22, we began this major downtrend that lasted most of the year, broke the resistance in the fourth quarter of last year, traded sideways most of this year. And, we'll see where things end up. It's like my view on this is, are people just pouring money into the market just to keep it up? Or, I don't know. I mean, it's just a little shocking with the yield curve the way it is. So And a very similar chart for the S&P 500 and also for the NASDAQ. They all look basically the same over the last 2 years. All right, let's get out of that and get to the economic data that came out this week. All right, so starting out with jobless claims. Initial claims came in at 218,000. Forecast was 220. Last week's number was 211. Continuing claims came in at 1.927 million. Forecast was 1.872, so about 50,000 over. Previous number was 1.841. New home sales came in at 679,000, under the forecast of 721. Last month's number was 719. Month over month contracted by 5.6%. We were expecting a contraction of 4.5%. Last month's number, it grew by 8.6%. Consumer confidence came in at a number of 102. Forecast was 101. The previous number was 99.1. And again, anything over 100 just is an indicator of expansion in the economy or optimism. Anything below 100 usually shows that it's more negative. GDP for the third quarter was revised up from 4.9 to 5.2%, and we'll get a finalized number on December 21st in a few weeks. So I'll be curious to see what the final number is. The personal income and outlays, income grew by 2.2% and spending grew by 0.2%. So that was a net zero there. And last up, the ISM Purchasing Managers Index came in at 46.7. Forecast was 47.6. So about, what was that, 0.9 below forecast. And the last month's number was also 46.7. All right. So that's all the data for the week. Let's get over to the market recap. U.S. stocks rise as Treasury yields slip despite Powell pushback on rate cuts. U.S. stocks climbed, extending the strong performance seen in November, with the S&P 500 and NASDAQ composite registering their most significant monthly percentage gains since July of 22. The Dow Jones Industrial Average posted its best month since October of 22. Despite Federal Reserve Chair Jerome Powell's warning against premature bets on rate cuts, Treasury yields fell sharply. Powell emphasized that it would be premature to conclude with confidence that a sufficiently restrictive stance had been achieved. The odds of a rate cut in March surged to 57.9, up from 21.6 the previous week. In corporate news, Tesla shares dipped around 1% after the electric vehicle manufacturer priced its highly anticipated Cybertruck at nearly $61,000, a 56% increase from their initial 2019 starting price. I think it was like 30-something, 39,000 is what I saw on the TV earlier. That thing is hideous. Elon's got some great ideas. I really appreciate his stance on free speech and a bunch of other things. But wow, that thing is just awful to look at. I mean, I got an F-350 sitting in the driveway. That thing is beautiful. I mean, great. Yeah, it's 7 years old at this point, but it's a gorgeous truck. That silver thing is just, oh. All right, moving on. Ulta Beauty impressed with its Q3 results, lifting full year guidance and expressing confidence heading into the holiday shopping season, resulting in a 10% stock jump. Meanwhile, Marvel Technology faced a more than 5% decline as better than expected quarterly results were overshadowed by weaker guidance attributed to challenges in legacy enterprise and carrier markets. Apple and Paramount Global also are reportedly in early talks to bundle their streaming services at a discounted rate. On the energy front, oil prices edged higher after the OPEC Plus agreement to implement voluntary output reductions and extended existing production cuts fell short of expectations. OPEC Plus announced a voluntary output reduction of 900,000 barrels per day, in addition to extending 1.3 million barrels per day in existing cuts. Despite the positive developments, Walt Disney stock fell 0.2% as it reinstated its dividend, but rejected a board representation request from activist investor Nelson Peltz's Triand Fund Management. All right, so lots of good news there. Let's move on to some data. U.S. manufacturing mired in weakness, economy heading for a slowdown. U.S. manufacturing showed continued weakness in October. November, as the Institute for Supply Management reported an unchanged Purchasing Managers Index of 46.7, indicating contraction for the 13th consecutive month. The extended contraction is the longest since 2000 to 2002. Factory employment declined further, and the new orders subindex rose slightly to 48.3, still indicative of contraction. Manufacturers cited the need to reduce inventory levels, and some industries reported a slowdown in the economy, attributing it to various factors, including lingering effects of the United Auto Workers strike. 3 industries, including food, beverage, and tobacco, reported growth, while 14 industries such as paper products and machinery reported contraction. Despite concerns about manufacturing, the overall U.S. economy continues to expand, growing at a 5.2% annualized rate in the third quarter. The persistent decline in PMI may overstate the weakness in manufacturing, as other indicators like long-lasting manufactured goods orders show strength. The report's looking forward indicators do not point to an immediate upturn in activity, but they also do not signal pervasive weakness typically associated with a recession. The ISM's employment gauge dropped to 45.8, reflecting attrition, freezes, and layoffs to reduce headcounts. So things are slowing down a bit. It's not a dramatic collapse yet. And it's kind of like the old saying goes is like, how did you lose all your money? And it's like, well, it was gradually until it was fast, or slowly until it was quickly, or something. It's something along those lines. All right, one last article here from Zero Hedge titled Recessionary Indicators Update, Soft Landing or Worse, written by Lance Roberts via realinvestmentadvice.com. The article by Lance Roberts explores the possibility of a soft landing for the U.S. economy in 2024, contrary to recessionary indicators that have historically been accurate. Roberts starts by emphasizing the significance of yield curve inversions as a predictor of economic downturns. While some argue that the usual relationship between the yield curve inversions and recessions might be different this time, Roberts asserts that the National Bureau of Economic Research's late recognition of recessions makes it imperative to consider leading indicators. Roberts tracks 10 economically important yield spreads, which are most of which are inverted, historically indicating an impending recession. He argues that when 50% or more of these yield curves become inverted, a recession has consistently followed. The article also addresses leading economic indicators, highlighting a drop in many of them in mid-2023, despite a subsequent improvement in economic activity. Roberts remains cautious and suggests that investors need to stay nimble in their approach, considering the impact of the Federal Reserve's aggressive rate hikes and fiscal policy changes. While Wall Street economists project a soft landing, in quotes, for the economy in 2024, Roberts maintains that historical indicators, including monetary supply trends, suggest a more cautious outlook. He concludes by advising investors to remain open to various possibilities and adapt their investment strategies based on the evolving economic and market conditions. Totally agree. Stay nimble, having a game plan for if, the Fed decides to cut rates and print money, you got to have a game plan for that. Got to have a game plan for if the Fed stays true to what they actually say they're going to do, because that's probably going to lead to some sort of a downturn. How bad it could be, I don't know. I don't have a crystal ball. Again, you have to kind of game plan all these situations out. And those are the two main ones that I foresee. Granted, there could be other things where we have, stagflation and, just a malaise through the economy. So but like I said, the two ones I'm really looking at are slash and burn rates because the economy is starting to wobble, or they stick to their guns and the economy just kind of trudges through a downturn, recession, whatever you want to call it, bear market. So we shall see. It is interesting to see where things are going and to watch the people on TV and the financial guys keep their heads in the sand and just be completely optimistic. I find it a little surprising. Anyways, all right. Well, that's everything I had for the week. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful weekend, and I shall talk to you next time. Adios.